Hi, welcome back to Investor Insights. Today, I want to talk about loss, or more specifically, how to handle, how to cope, and how to live with losses. It doesn't matter if you're an investor, a trader, a speculator. Anytime you buy something, you're putting your money at risk. There's no such thing as a certain thing. And anybody out there who tells you that they have never made a loss, well, I can guarantee you they're feeding you a whole bunch of bull manure. Well, what's to talk about when it comes to losses? Well, nobody's perfect. Nobody can pick tops and bottoms. Nobody is able to just come up with a magic formula to consistently make money. And certainly nobody can always pick a stock that can just burst out of the blocks, make money from day one, pay big dividends, huge capital gains, and be taken over at a 500% premium. You know, that's fantasy land. But I'm giving you real world insights. So, first things first, how do you live with losses? Well, I think the main thing to think about is how big was the loss. Now, I've made other videos on things like on subjects such as capital preservation, living to fight another day, and the right mentality when it comes to investing and trading, taking into account the downside potential, the loss potential. So, depending on the size of your loss, best to give an example, if you have 100 grand and you take a 10% hit, 10 grand, it's not small change. But at the same time, 10% is not going to kill you. You still have 90 grand. And quite frankly, in a volatile market, things swing 10, 15, 20%. And it all comes down to timing, obviously. Now, I'm not just talking shorts on the long side. I'm also talking about losses on the short side. If you happen to short the market and it explodes up, well, you're just going to get crunched. It's the same as you going long in a falling market. And you can just as well just call it quits. You know, it's very hard to pick the exact timing for a trade so that you make money from day one. Now, as I said, it's not the fact that you've made a loss, but the size of the loss that's going to determine if you can live to fight another day. I mean, if you put 100 grand down and you're down 10%, as I said before, you're going to live. You put 100 grand down and you're down 50%, and you should have never let it run for that long, that deep, and for that much pain. Well, you might take a break and reevaluate your strategies, reevaluate your trading methodology, change your mentality towards hanging on to losses. But ultimately, if you're committed to the cause, you basically will learn to fight on. Because ultimately there's no better reward than being a profitable trader or investor. The world's richest people, I'm not talking about people who inherited their fortunes like royalty and trust fund kids. I'm talking about people that started with nothing and have made an absolute fortune, are long-term investors. And these folks make bad decisions, but because they're so wealthy, they can afford to take these losses. But in the long term, they're ahead. And that's the attitude that you got to have. You know, it's 1 or 2 losses, put them behind you and move on. This is very important. Dwelling is not going to help. What's going to help is learning from your mistake, not doing it again. Secondly, when it comes to losing, you've got to look at what actually made the loss in the first place. Was it research? Was it inadequate education on your part with that stock, or the sector, or the market, or the economy? Was it just bad luck? I mean, it happens. And a couple of years ago, I got quite a few people into QBE at $13 odd, and within 2 weeks of getting in, and that was with a 10% dividend yield, some announcement came over from the US about possible SEC investigation into a company that QBE bought a year prior to that for basically nothing. And I don't even remember if it was cooking the books or whatever to that effect, but QBE was in a trading halt, and I happened to be in surface at the time, and when the stock reopened, man, it dropped $2, and then the next day it dropped another $2. I mean, to take a $3 or $4 hit on a $13 stock, damn. But this is where education and research really pays off, because the way to analyze the situation was, okay, we're down easily 30%, at least 25-30%. Most of my people, the main thing going through their mind was, is this going to go to $5, $6? I mean, they got in at 13, it goes to 5. Man, they got wiped. But I just took a step back and looked at the situation, and I remember this company that QBE bought through its worldwide expansion plans. It bought this company for about $150 million. Now, QBE's market capitalization at the time was roughly about $15 billion. Now, this company that was being investigated was being looked at by the SEC for things that it did even before QBE bought it. So QBE was not indictable, or nothing could have happened to QBE except they write off that $150 million that they spent on purchasing that company. Now, think about this. That company is worth $15 billion, and one little piece of it that was worth $150 million, so basically 1% of its market capitalization, caused this stock to fall 30%. Right. The easiest thing to do for QBE to just get that monkey off their back was just to fold up the company, sell off the assets, write off the $150 million. And I just told people to hang tight. I didn't see any reason to sell, but a lot of mum and dad investors out there, and probably the hedge fund community and the mutual fund community, just jumped in and sold the living daylights out of it. I mean, it dropped to, I think, $9.80 odd from the mid to high 13s, I think it was. I just didn't see the reasoning why $150 million piece of that company would write basically maybe $5 billion off the market value of the entire organization. That's crazy. Now, the point that we got in on QBE was that we were earning a 10% dividend anyway, so we were being paid to wait. Within a month, it was straight back at 13. The SEC didn't find any wrongdoing, and life went on. And that's a very good example of how to handle a losing situation. Know your company. Yes, it was bad timing and it was bad luck. But ultimately, the correct education, the correct mentality, and the correct knowledge of how to handle the mathematics, the situation, the possible further downside of this whole kerfuffle. Everybody got out in the money. I don't know a single person that lost money on QBE. So losses aren't the end of the world. But you have to know your loss potential, your down potential, especially if you're trading. If you're investing, it's a slightly different ballgame. But especially when you're trading, if you're trading using leverage on, say, a FX account, an FX trading platform where you're levered 50, 100, 200 to 1, I mean, 10 grand capital you put in there can be wiped with a 1% move on 100 to 1 leverage. You gotta keep tight stops. You have to keep a very short leash on every position. Cut your losses short, let the winners run. But in this market, especially with currencies, things are swinging absolutely. The swings are crazy. I would not be hanging on to any long-term positions apart from a short in the Aussie dollar or a short in dollar yen, because everything just moves. You normally have, in the old days, weekly moves of maybe 150 basis points, maybe 200 points on a very volatile week. Now, that's your range for the day, even on the Aussie dollar. It's too hard to wear big losses and hope for it to come back. And this is where the next subtopic I'm going to be talking about is the mathematics of losses. And this is where you have to learn when to cut your losses. I'm sure they asked you back at school, if you have an asset and it drops 10% and then it makes back 10%, are you even? And the answer is no. So if you have something worth 100 grand and it's dropped 10%, you're down to 90 grand. It's up 10%, you're back to 99 grand. So you're not quite back to evens. And that becomes more evident the bigger the drop. So obviously, if something's down 20% and you get back 20%, you're a lot further from breaking even than being down 10% and coming back 10%. Try 50%. If you're down 50%, your stock's got to double before you break even. Now, regardless of how clever you think you are or how knowledgeable you think you are on the markets and stocks, sometimes bad luck just hits you and you just got to call it a day. Yes, it might come back, but man, preservation of capital is imperative. So normally with very, very short-term trading positions, you gotta keep a stop loss at a maximum of 10% of your overall account. Once it goes beyond that, you're playing with fire. Because the bigger the loss, the harder it is to let go. So cap them off at 10%. When it comes to stocks, you got to look at dividend yields. If a stock is paying you 10% a year, and through the year you might be down 10%, it's not worth leaving. Because the dividend yield puts you back at even Stevens. So that's okay. And you would even give yourself maybe some further downside up to 20%. So you can break even in 2 years. But in 2 years, if it doesn't come good, just walk away even. This is a very rough example. There's certain conditions where, regardless of, even if you're down 5% and things are looking really bad, cut your losses, walk away, come back to fight another day. For example, if somebody declared war or the market started crashing and you were up 20% but you're now down, 5%, man, just go. Because for something to have dropped 25% like that means there's much, much further downside. You can always time it better and get back in there when it's cheaper. But that's another lesson, trying to catch a falling knife. I want you to really think about losses when you invest or you trade. This video has been quite long, but I really wanted you to spend some time listening to and thinking about what I've just said about losses. Because this should be one of the primary concerns that you have before you invest or trade in any instruments. So until next time, happy trading and good luck with everything.